So let's talk about the mortgage process from start to finish. Whether you're a seasoned buyer or it's your second property or second mortgage, or this is your first time, you've heard these words of pre-approval, underwriting, clear to close, but nobody explains what that means. And that unknown creates stress, issues come up, deals get messy, and then people start to think that everything's happening to them instead of for them. So what we're gonna do is we're gonna talk about what happens, when it happens, and why it happens. Let's get started from the beginning. So step one in the process, the pre-approval. I want to stress a pre-approval and a pre-qualification are not the same. A pre-approval, typically your credit is pulled, income documentation is provided, asset documentation is provided. We run a actual underwriting system on your file to make sure you qualify. A pre-qualification, those items are talked about but not verified. It's always important to know the difference between a pre-approval and a pre-qualification. Always go the pre-approval route. It makes all the difference in your process. It makes all the difference in your confidence of your offer, and it makes all the difference in getting you closed on time. During the pre-approval process, the documentation or the things that we talk about are really fourfold. We'll talk about income. So we will need your pay stubs, W-2s, work history. We'll need assets. It's essentially where's the money coming from, whether it's bank statements, retirement accounts, or gift funds from family or friends, or a sale of some property. We'll talk about the property type, whether it's a primary residence, a vacation home, a condo, a single family home, a mobile home, a farm. All these different things play a role. And the last thing we're going to talk about is credit. What is your credit score, your credit history? How does that reflect and how does that make a difference in regards to your file and what you qualify for? We're going to talk about these four main steps: income, property, assets, and credit. Most problems in the mortgage process stem from a bad pre-approval call. That's why I say it's so important to have the right conversations up front. Be honest with your loan officer, be honest with your team. They're on the same side as you. Make sure everything is known up front so you don't have any of these hiccups in process. I can't tell you the amount of times that we've been in process and stuff is uncovered as we go through. The worst thing is when an underwriter finds out something before you do as a loan officer, and then you have to pivot and adjust and potentially restructure your entire deal. Step two is house shopping. Now that you know what your pre-approval amount is, whether it's $100,000, $500,000, $1 million, $2 million, you can now confidently shop for that home that you're looking for. So I always tell people, and I tell my realtor partners the same, don't look at any homes without a pre-approval. You may have an idea, but the reality is you don't know fully. Little things can make a big difference. So now you're starting to look at homes. You're starting to look at a range of purchase prices, the communities you like, the amenities you want in your property. All of these things take into effect now that you know exactly what you're pre-approved for. So this is where the negotiation part happens. This is where who you work with matters. On the real estate side, makes a big difference. Not all real estate agents and real estate brokers are created equal. I can promise you that. But the reality is you need somebody in your corner to help you negotiate, structure transactions, set up your deals, and make sure you're offering the right prices because they know the areas better than anybody else. I can give you my best advice, but the reality is a trusted real estate professional is going to be the one who can help you put in a strong offer, negotiate on your behalf, and get you into that dream home. It makes all the difference. Some of the things that can come up during your offer process as you've seen home is you're going to submit an offer. Let's say a property is selling for $200,000. What you can do is, as a buyer, you can offer a purchase price on a home and then ask for something called seller concessions. Seller concessions are essentially credit from the seller to go towards your closing costs. So for example, on a $200,000 purchase, you can offer $200,000, and along with that offer, you're requesting the seller pay you 3% in seller concession, or the equivalent of $6,000. If the seller agrees, that $6,000 is then credited to you at closing to go towards your closing cost. You're still offering $200,000. Your mortgage is based upon $200,000, but the net amount that the seller receives is now less by $6,000. So that $6,000 essentially, for lack of better words, is financed into your loan, okay? So you're allowed to take those closing costs and put it into your mortgage. Sometimes, let's say the seller's not willing to take less, what you would do as a buyer, and you'd weigh this out with a real estate agent to make sure this can happen, is you would offer slightly higher than the purchase price. Instead of offering $200,000, you would say, hey, we're gonna offer $206,000 for the property, but we want $6,000 back as a seller credit. It allows for the seller to net the same amount and allows for you, the buyer, to not have to come out of pocket those closing costs, okay? Doesn't happen on every deal. Your real estate agent is gonna let you know if it's even possible. You know, if it's a really, really popular house, the odds of you getting this seller concession are a lot slimmer, you know, if there's multiple options. But if the house has been sitting for a minute, you know, they haven't had a lot of offers, you may be able to put yourself in a position to have the seller allow you to finance your closing costs. It's a huge win for a lot of people. We're seeing it more and more as times are changing, but that's something to take into consideration, okay? Now that you found a home, your agent's gonna submit a purchase agreement to the listing agent. It's essentially your offer. You wanna buy the property for this price, you're gonna use this type of loan based upon your pre-approval, this type of down payment based upon your pre-approval, you're gonna close in this type of time frame. So you submit that offer. offer. Once you submit that offer, let's say everything goes well, there's not too much negotiation back and forth, and the seller agrees, the seller will sign the contract, and then it's up to the buyer to sign that contract again. It's called bottom lining. At least that's how it is here in the state of Michigan. The seller or the buyer will bottom line. They will be the final signature on the purchase agreement that says, hey, we all agree to the purchase price and the purchase structure of the transaction. Everything goes well, you are officially in contract. That being said, the next steps are important as well. So what happens is a couple things are going to happen simultaneously. So you're going to, as a buyer, you are typically, unless you negotiate out of it, but you are typically entitled to an inspection period. That inspection period is where you will hire an inspector to come and take a look at the property. So a good inspector will check your house, all the bones, the roof, the attic, the basement, the foundation, the furnace, the water heater, the water pressure. They're going to check the tiles. They're going to check the lights and the power. A lot of these inspectors are absolutely fantastic and will really help you in regards to purchasing a property that you and your family are going to enjoy, not spending a ton of money in fixing or a ton of money that you're not expecting. And then two, the safety of your home. You know, deals die or deals fall apart every single day after inspection because some things come up that buyers are just not willing to negotiate. Or even sellers. Some sellers are not willing to pay the money to get things fixed. And that happens. What's good is that inspection period protects the buyer in regards to the contract so that if something comes up, you can renegotiate or have the seller fix it, or you can back out of the transaction. You know, it protects you so that you're not buying a home that is not up to your standard or up to even, sometimes safety standards. So those are the type of things that can happen in that inspection period. At the same time as your inspection period is going on, your real estate agent or yourself will typically send over the purchase agreement to me or my team as a lender. At that point, we can officially submit your loan into process. Because you're pre-approved the right way, we have all of your income documentation, we have all of your asset documentation, we understand how to structure the deal. Now we have that purchase agreement, we're going to submit your loan into it. So at that point, we'll generate what's called your initial disclosures. Your initial disclosures are essentially your preliminary structure of your loan. What your down payment is, your purchase price, your estimated value, taxes, insurance. The rate may or may not be locked depending on what you and your lender decide to do. And once those documents are completed and signed, really mainly understood, at that point we will order the appraisal for your property. At the same time as ordering the appraisal, the process essentially starts. Loan is submitted, income is verified, and you're into what's called underwriting. Sometimes lenders, even myself, will interchange processing and underwriting. At that same time, you as a consumer may or may not be requested for additional documentation. For example, let's say by the time you're pre-approved and the time that you're in underwriting, it could be the difference of a month, okay? And that happens because it takes time to find the right home. So if in that month, we would need to get updated pay stubs. We would need to get updated bank statement. If nothing else changed, that's pretty much it. But what if in that month time frame, you change job? What if you got a promotion? What if you got a demotion? You could lose your job. All of these things need to be verified and checked to ensure that you're eligible and qualified to purchase the home. At the same time as underwriting, the lender typically will order title. What we mean by that is we send an order to a title company, typically of your choosing, that would verify that the title itself, the deed to the property, is clean and that the transfer at the end of this purchase is not going to have any issue. Because sometimes sellers don't even know that they have additional liens on their property until they go to sell the home. Let me give you an example. Client had a contractor come and renovate their property. Client didn't pay the contractor. This could have been 10 years ago. The contractor at that point puts what's called a manufacturer's lien on the property. That lien has to be paid, has to be fulfilled before the property can close. As a buyer, you're like, hey, why does that make a difference to me? I don't owe that. You're right. But if the seller does, and now the seller has to pay an additional $50,000 at the time of close to pay off this lien, the seller may not do that. The seller may not have the proceeds to make that happen. So we ensure that your title is clean. So at the time of closing, you know you own that property and only you are on that deed. As this is going on, your appraisal has been ordered. Let's say that's taken place and has come back. So what the appraiser looks at on your home is they look at the age of the home, the square footage of the home, the number of the bedrooms and bathrooms. That's really the main item. Obviously, they take into consideration updates and things you've done to the property, but those are the main points. So when they take that home's value and they compare it to other homes, that's where they're comparing it to. For example, you bought a house, the house is for $550,000. It's a 4-bedroom, 3-bath home built in 1990. That home, the appraiser, it's his job to take that value, make sure your purchase price is worth what you're buying it for and worth the loan that it's going to be tied to that property. So that $550,000 home, you would take and see what other homes have sold in the area for that price that are similar in qualification. You may look at homes that are a few years older, a few years younger, a little bit bigger, a little bit smaller. They have a formula that makes adjustments so that it all equals out. And it's at that point where they come back with their appraised value. When that appraised value comes back, a few things can happen. Your home can come in right on the spot. Let's say it's 550, come in right at 550. It can come in low, it can come at 500, or it can come in high, it can come in at 600. For example, in the event that the appraisal comes in right on the money, nothing to worry about, you're good to go. If the property comes in less, this is where another negotiation may come in handy or may come into play. So let's go back to the example of 550,000. Your purchase price is 550, it appraises for 500. At that point, it's up to you, your real estate agent, to negotiate with the seller in regards to how you're going to continue the loan. Because the lender, we cannot finance on anything over the appraised value. So now we're looking at everything at a $500,000 value. That being said, a few things can happen. You can either pay the additional difference out of pocket, so in this case, 50 grand. You can negotiate down to the appraised value, let's say down to 500, or you can meet in the middle, and let's say you come up and you pay 25,000 out of pocket, the seller drops their price by 25,000. Or on a worst case scenario, end all be all, you can walk away from the deal and you're still protected. That is what can happen. Sometimes these appraisers are what we call subject to. So if the appraiser goes into the home and they notice that, hey, the roof is damaged, or there's a lot of siding that's damaged, or the concrete's damaged, or the hand railing is messed up, they may mark your appraisal subject to. What that means is this is the value subject to these repairs being fixed. So that's another negotiation item, or another item you have to deal with in regards to the appraisal. So you as a buyer and your agent would go back to the sellers and say, hey, these are what need to be fixed for the appraisal. Sellers at that point can tell you, we're not doing it. They can fix it, or they can walk away from the transaction. But those items that are on the appraisal must be fixed. You cannot go past those items. So for example, an easy one, there's a chipped paint on the outside trim. The seller has to scrape the paint and repaint it. Not typically a big deal, but sometimes they'll come in and say, hey, the roof is really bad. There's missing shingles. There, you potentially could have a leak. And they say, hey, you got to patch the roof or fix the roof or even replace the roof. And a seller may say, hey, we're not doing that. And they may walk away from the transaction. Something to take into consideration. Those items that need to be repaired are not on the buyer to repair. They are on the seller to repair. And I never advise buyers to do that and make those repairs, because the reality is it's not your home yet. You know, you're going to spend the money to fix items on somebody else's home. If something happens and your deal doesn't close for whatever reason, you've now spent the time and money fixing somebody else's property for him or them to sell at another time on your dollar. So appraisal's been completed, underwriting's been completed, there's no other additional items, title is clean. At that point, you are submitted for what's called clear to close. What that means is, hey, you're good. Everything checked out. Your income checked out, your assets checked out, the property checked out, your title checked out. You're now at the point where you're able to close on your loan. So congratulations. That means you're cleared for close. So at that point, what happened, you would coordinate with the title company and they would schedule your closing together. So either you can close together with the sellers or close separately. Once they figure out the closing date is when your final documentation is essentially going to be processed. On closing date, this is where all the fun begins. I typically will go over majority of closing documents prior to closing. Even if it's the night before or the morning of, I like to go over them with my clients so that when they get to the closing table, I can't always be at every closing. So when they get to the closing table, they're already confident. They know what numbers to expect. They know what documentations that they're going to see so that the process is smooth and light and comfortable. There's nothing worse than a buyer getting to the closing table and the numbers aren't what they're supposed to be or not what they're expecting. Okay. On closing day, make sure you bring your driver's license, make sure you bring a pen, make sure you bring a smile. And if you're bringing cash to close, you can either wire the funds ahead of time, so bring your receipt, or you can bring a cashier's check. Some title companies up to a certain amount will allow you to bring a cashier's check. Do not bring cash. They will not take cash. That being said, the process shouldn't take more than a few hours. Once documentations are completed, sellers and buyers sign alike, those documents are sent back to us for a final authorization for funding, and we check off the box. At that point, you own the home. The property is now with the title company. It's going to be recorded. Your loan has been finalized, and you're good to go. And the last thing I want to talk about is post-closing. So what happens after? Most of this doesn't necessarily matter to the buyers or to the clients directly, but I always like to kind of give everybody an idea. So as a lender, we take your documents, we record your mortgage on your title. All of that is completed. We then process your loan. You probably a week or two later, you'll get an email to set up your automatic payment. At that point, your mortgage is now with the lender. So the lender may do a couple things. They may decide to service your loan for a period of time or forever. They may sell your mortgage to a different servicer. So if your loan is sold, some people get super uncomfortable with it, but there's nothing necessarily to be uncomfortable about. Nothing in regards to your loan term changes. Your loan stays exactly the same. The payments stay the same. The structure stays the same. What's different really is who you make your payments out to. Okay. So if your loan is sold servicing, not a big deal. They're going to let you know ahead of time. So it just doesn't happen overnight so that you can make your payments and make adjustments to your payments accordingly. So that's the mortgage process, start to finish. No buzzwords, no mystery, no panic. If it's all done right, it's honestly pretty boring. And you know what? Boring is good. If you're ever in the market, if you're trying to plan ahead, looking to refinance or purchase a home, feel free to give us a call anytime. I'd love to help, even if it's just guidance. If you're not my client and you have questions, call me. I'm here to help. That's what we're here for. If this video helped, please save it, like, comment, subscribe. This is my first YouTube video. Please give me some grace. It's going to get better, I promise. Thank you guys. And if you need anything, again, call me anytime.